Imagine this. You can get 4.3% interest with no risk whatsoever, simply by buying U.S. Treasury bonds. It's a hard proposition to refuse. In fact, investors are gradually abandoning stocks for this guaranteed safety. Bonds are suddenly becoming competitive. Why accept market volatility when the federal government offers you stable and safe returns? However, this situation creates a major problem for indebted companies. They must refinance their existing debts at much higher rates than before. In fact, a small business that borrowed at 2% 3 years ago must now negotiate at 5 or 6%. These additional costs directly erode their profits. Margins are shrinking. Future profitability becomes uncertain. Understanding this means grasping that interest rates work exactly like gravity on stock valuations. The higher rates go, the lower valuations fall. It's an economic physical law. So when Treasury yields rise to 4.3%, the valuation multiples of companies are pressed downward. Investors regain control. The turbulence you're observing, it comes directly from this inevitable mathematical reality. Look at the market today. The Magnificent Seven completely dominate, in fact. Microsoft, Apple, Nvidia, Tesla, and the others are rising solely on artificial intelligence promises. No solid fundamentals really support these valuations. Investors are buying the story, not the results. It has become a collective bet on the future. Besides, look at the numbers. Hardly any stock exists anymore below a PE ratio of 25. Everywhere you find 30, 40, sometimes 50. That is to say, investors are paying $50 to earn $1. Rational valuations have simply disappeared from the market. Attractive opportunities are becoming impossible to find. That's why Warren Buffett is currently accumulating record cash levels. The man simply can't find anything worth buying anymore. His billions sit in cash, waiting for reasonable prices. Buffett is waiting for a correction, a chance to invest meaningfully. When the best investors step back, it's a very clear signal. The market has lost its foundation. Bitcoin explodes at $50,000. Immediately, millions of new traders arrive. They all seek this same thing: quick profit, without effort. In fact, they forget a simple rule. Markets reward patience, not impatience. This mentality creates a dangerous dynamic where emotion replaces strategy. This massive speculation amplifies every market movement. Prices shoot up too fast, then collapse brutally. Besides, it makes sense. When all traders panic together, nobody buys anymore. Volatility explodes in both directions at once. It's like a pendulum gone crazy. And that's precisely where truly rare opportunity is born. After every spectacular crash, it's always the same story. Traders panic and sell at the worst possible moment. Those who keep their cool buy at the lowest price. For example, during corrections of 30-40%, true investors were quietly accumulating. Collective panic, therefore, creates the best entry window. The market ultimately rewards. Here's the truth that novice investors completely ignore. The market is not your enemy. It's simply a machine. In fact, this machine works for you if you accept waiting patiently. Other traders panic, sell carelessly, create waves. You stay calm and observe. It's this mental difference that transforms chaos into wealth. Let's look at Warren Buffett very carefully. When Apple explodes to historic highs, he gradually sells his positions. By the way, in 2008, when markets completely collapse, he aggressively buys beautiful assets at bargain prices. This isn't luck, it's a deliberate strategy. Collective emotions create the best opportunities for those who remain methodical. Imagine this precisely now. You have a card with exactly 20 investment opportunities. Your mission is to choose only a few throughout your entire career. So you patiently wait for the market to serve you the best deals. This mindset changes everything. You invest only when conditions are exceptionally favorable. Waiting becomes your greatest strength.
The first approach is simple. You accumulate liquidity, cash money, and you wait. Markets panic, prices collapse, everyone sells in a rush. At that precise moment, you strike. You buy big when others are afraid. This strategy requires mental discipline, by the way, because waiting is psychologically difficult. The other path works just as well. You broadly diversify your portfolio, so you buy a little bit of everything regularly. Each month, you invest without asking yourself if it's the right time or not. For example, ETFs or varied stocks. You forget about timing. Statistically, this method outperforms market prediction attempts over the long term. This is the key point we always forget. When others panic and make massive mistakes, you benefit directly. Crashes are not catastrophes, actually. They are historical sales. Those who waited patiently or continued investing regularly become wealthy during these periods. Two different strategies, one single result: prosperity.